Hello and welcome to Let's Talk Business. I'm Priyanshi Sharma and let's start with how the markets performed this Monday. Well, benchmark indices were steady through the day and ended marginally higher in trade. Metal and energy sectors rose, whereas IT and realty shares declined. Alex Matthew joins us from the BQ Prime newsroom with a wrap of all the market action. Over to you, Alex.
A weak day of trade for the Indian equity markets. If you look at the benchmark, it doesn't look too bad with gains of about 0.1% for the Nifty 50. But you look a little deeper and you'll find that a lot of this, or rather all of this, is on account of one counter, and that's Reliance Industries, which gained about 4% or thereabouts in trade today, contributing all of the gains on the Nifty 50. You saw the metal index as a whole that also contributed, and a few of those components were shining in trade for the Nifty 50 as well. You had Tata Steel as well as JSW Steel end with gains of close to 3% each. You also had the likes of Bharti Airtel, Adani Enterprises, HDFC Life, Sun Pharma, Bajaj Auto, as well as Hindalco gain over 1% in trade. But a bulk of the Nifty 50 as well as a bulk of the market as a whole traded in the red. You saw the market breadth favoring the declines. And the worst performers on the benchmark index today were the IT majors. You saw HCL Tech, the worst performer, down about 3% in trade. You also saw Wipro and TCS that lost ground and were among the worst performers. All three of those companies will be reporting their earnings for the first quarter later this week. And it seems that concerns about the outlook for the current financial year for these IT majors is rising as we speak. The other counter that underperformed today was Titan, which lost about 3% on account of a downgrade by a leading brokerage firm. And that's because the lean season for this jewelry major is going to be larger this financial year, and that's not very good for the business outlook for this financial year. From the sectoral perspective, you saw IT as a whole that lost about 1.2% in trade, and a bunch of other sectors also lost ground, not least of which the FMCG index, which was down about 0.8%, and auto as a pack, which also lost about 0.6%. I mentioned at the start, metal was a bright spot. That was the one sector that gained about 1.7%, and you also had oil and gas on account of Reliance Industries that was up about 0.6%. Attention focus changes to earnings now. IT is just around the corner, and the profit booking that you saw at the end of last week seems to be taking over this week as well. That's at least what we saw in the first trading session this week.
And in a conversation with BQ Prime's Neeraj Shah, Motilal Oswal's Prateek Agarwal gives an overall outlook of the real estate market. Listen.
Real estate cycle has a lot of strength. We are glued on there. There is some amount of pent up which is there, and people who are less positive because interest rates today are higher than they were in the past. Point is, now everything is variable interest rates, and at a point interest rate hence doesn't matter. You may have bought something when it was lower, now you have to pay more. If you bought today when it is higher, tomorrow you may have to pay less. So, and I think companies are going out of the way to even smoothen that for the buyers. So the thing is, if India grows strongly, and it has been doing quite well, newer industries are coming up, newer locations are popping up. So people would need housing in those spaces as people get called back to work in the IT space. Again, in certain geographies, we are seeing very good housing demand. So I think this is something which is sustainable. More expensive locations also, like Bombay, are seeing good demand. So cheaper locations where you see newer businesses move are really seeing very good demand. So in terms of investing, we have very little exposure as a house to real estate. We are more exposed to real estate ancillaries. So cement is something that we have some exposure to. But what happens is when a house gets built, pipes get fitted, so we have some pipe companies, cement companies. A house is the biggest expense. So ancillaries in many cases are, to our mind, a better way of playing this space rather than buying builders themselves.
And Reliance Industries was the talk of the Dalal Street today. The stock surged to a 52-week high, adding 70,000 crore rupees to its market capitalization. This says investors made a beeline to buy the shares following the announcement of the record date for the demerger of Geo Financial Services. PQ Prime Sajit Mangat spoke to Deven Choksi of KR Choksi Shares and Securities about the road ahead for Geo Financial Services. Listen in.
Geo Financial Services, I think it looks, reasonably clear proposition at this point of time. On one side, they are starting with a net worth of around 28,000 crores, which is cash net worth in the balance sheet. Along with that, they have got the holding, 6% plus holding in Reliance Industries, which is basically valuing somewhere around 110,000 crores plus. So somewhere in the vicinity of around 130,000, 140,000 crore worth of book size of the net worth, I think that the company is assuming to get started with. That number itself, I think, will put Geo Financial Services ahead of everybody else in the listed universe included in our marketplace. Because I think the size of the NBFC would be, I think, far bigger than even the largest NBFC, which is Bajaj Finance. Bajaj Finance currently holds net worth of around 45,000 crores, as against which you are talking about 3 times plus higher amount of net worth for Geo Financial Services of 1,30,000-40,000 crores. So that would possibly put the book size, potential book size for the company eventually between 7.5 lakh crore to 10 lakh crore. I think which would probably, in my viewpoint, happen over next 3 years' time.
Moving on, the earnings season is round the corner and it is the IT companies which will kick off this season. Analysts expect that constrained spending by large banks will weigh on sales and profit margins. Tushar joins us with the details.
For Indian IT companies, the first quarter earnings are likely to be in various shades of grey. April-June is traditionally the strongest quarter for Indian IT firms, but not this time. A banking crisis in the biggest market, the United States, has constrained spending by large banks, and that's weighed on revenue and margins, dragging on the earnings outlook for the year. What one should watch out for is deal making in Q1. The project ramp down seen in January-March will show in Q1 earnings. The deal making pie has shrunk. A lot of companies are vying for fewer deals, and that's likely to result in pricing pressure, which effectively means a hit to revenue and margins. Clients are also looking at insourcing rather than outsourcing. Point in question is TCS's scrapped 10-year deal with Transamerica. Add to that wage hikes in the new fiscal, and you're looking at even more pressure on margins. Another thing to watch out for is company commentary on how they see the second half of FY24. That's important because while a washout in the first half was a given, now the entire year is seen under pressure. Analysts believe that the full year will be a washout now. But there's a silver lining. TCS and Infosys, the industry bellwethers, have clocked some large deal wins in the recent past, and the generative AI bets are starting to pay off. And according to some reports, they are also hiring more. All said, we can expect and anticipate the worst, but the real picture will be clear in a couple of days. TCS kicks off the earnings season on Wednesday.
And the 50th GST Council will meet tomorrow in the national capital, and on the top of the agenda is the discussion on tax levy recommendations on online gaming, casinos and horse racing. My colleague Janani joins us with the details of what else to expect from the Council's meet.
On Tuesday, the 50th GST Council meeting will take place in the national capital, and on the agenda are some much anticipated subjects, such as the GOM report on online gaming, casinos and horse racing. The GST Council members will be voting for a rate of tax and the mechanism of levy or the point of taxation for the 3 above mentioned events. Now we have to remember that the report on the subject was submitted way back in December, but a final call has not been taken. Also on the agenda is the implementation of the GST Appellate Tribunal. The Council approved the setting up of the Appellate Tribunal in its last meeting in February after the budget. However, legislative changes are yet to be made by states, and a communication on the number of benches that each state is requiring is also yet to be received. The constitution and structure, however, were approved in the last meeting itself. Now, we've learned by talking to some member ministers that some aim to bring forth the matter of revising the revenue sharing model between state and centre. Currently, the sharing ratio under GST is 50-50. The Council will also discuss on various recommendations made by the Fitment Committee, such as exempting tax on the import of certain medicines, including cancer treatment drugs, exemption on private satellite launching services, and a clarity has also been sought on the taxability of food and beverages served in cinema halls. Now, currently they're at 18% like all restaurant services, but this could change. A taxation on multi-utility vehicles is also being sought, and the department is likely to get the council to vote on measures to curb fake GST registration and fraudulent IT claims. This means drawing stricter verification boundaries like biometric identification and even physical verification in some cases.
And moving on, torrential rains are lashing North India. The rains have wreaked havoc, leaving a trail of deaths and loss of property in several North Indian states. But the states of Punjab and Haryana will likely get some relief very soon. According to the SkyMet President GP Sharma, the situation in these two states and Jammu and Kashmir is likely to improve starting today. Listen in.
Mountains will have a relief. Okay, I think the relief will start for Jammu Kashmir region today itself. Okay. Himachal will have one more day, today also activity, and then tomorrow onwards I think it becomes better. Uttarakhand will have to wait for possibly another total 3 days or so. It will come under inclement weather conditions. As far as the plains are concerned, yes, you can expect improvement over parts of Punjab, Haryana. Delhi will also have mild activity as compared to the previous 2 days. Today also, you can expect some rain shower. One odd shower will be very intense and heavy also. But that is total. For the past 2 days, Delhi experienced triple-digit rainfall, more than 100 millimeters on 2 successive days. It doesn't normally happen. Delhi doesn't see. Next 2 days, today and tomorrow also, showers are likely, but then the intensity will be less, as well as they'll be intermittent. They will not be continuous rains. Okay, so will be the case with the other parts also of Punjab, Haryana and adjoining region. Most of the weather activity in the coming days, that's about next 3 days, that will remain confined to parts of Rajasthan, Madhya Pradesh, North Madhya Pradesh and West Madhya Pradesh, and also southwestern parts of Uttar Pradesh and adjoining Uttarakhand. This is the pocket which is going to be very active in the next about 3 days. Yes.
And that's all we have for you in this segment of Let's Talk Business. Thanks very much for watching. News continues on the other side.